So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys? And welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and today we have a very special treat for you. We have Mr. Kansas City, an icon, mentor, friend, raise master, all of the above. He is Mr. Logan Freeman. He's the co-founder and principal of FTW Investments and serves as the chief development officer. Logan has facilitated over 150 million in real estate transaction. Logan has a unique understanding of the needs and wants of sophisticated investors, enabling him to effectively support individuals and organizations along their investment journey. Logan is particularly adept at sourcing off-market properties, with more than 50% of his completed transactions involving off-market properties. Having completed over 150 transactions, Logan has found a reliable process for executing real estate transactions. He is an advocate for affordable housing and works closely with many organizations in helping to end homelessness in Kansas City. Understanding how to do well by doing good is Logan's motto and has made it his why for doing business. He holds a master's degree in business administration from the University of Central Missouri. Logan, welcome.
Jonny, thanks for having me, man. I've been looking forward to this conversation, and I know it's going to be a good one.
Likewise. Always love chatting with you. Like I mentioned, I definitely consider you a mentor. We met back in Austin at the Raise Masters Retreat. Was a great time. Are you headed to Miami?
I haven't decided yet. We'll see. I'm hoping that I can maybe get my wife to come with me. We'll see. But with the two little ones at home, getting her away from any period of time is pretty difficult. So still checking that out. Nice.
Super fair. We got some time to decide for sure. But let's kind of jump into it. You have an awesome story, and I want to touch on that before we get into, we have so much to talk about. So just kind of give us kind of Reader's Digest version. You played football, and here you are. So kind of bring us through that.
Yeah. So grew up in Jefferson City, Missouri, which is the capital of Missouri, and really identified as an athlete my whole life. I found a lot of refuge and I think comfort in athletics, and played collegiate football at the University of Central Missouri, had brief opportunity to play in the NFL, and was cut. And at that time I had the opportunity to continue. I was burnt out, man. And I just really felt like I had a different calling, and I just didn't have any passion for it really. And so my whole goal was to make a practice squad and make that salary for a couple of years and then get into real estate. And so anyways, it happened a different way, but moved to Kansas City and, really started to try to figure out, okay, how do you build wealth? And who do I know that has built wealth, and what do they do differently? And I had read all the books, right? Rich Dad, Poor Dad. I've been through all the podcasts and really got the idea that I think real estate was where I wanted to try to build my wealth in it. And so, I had the opportunity after getting cut to move to Kansas City, bought my first home, did a live and flip. And, when I flipped that house, I made more than my salary that year. That's when the light bulb went off. I said, okay, I think that there's outsized returns out there in the marketplace if you're willing to take some risk, mitigated risk, hopefully, but you got to go make it for yourself. And so I was still a W-2 employee. I left a large company, went to a small startup, was there for about 3 years with 3 other guys, helped them scale, met my wife, met the best man at my wedding. Fantastic opportunity. Left there, went to a larger company, and this is when I found out I was unemployable. I was fired from my job in I was there for 15 months. This would have been 5 or 6 years ago. So you guys can do the math on that. I don't know what year it was, but my wife said, look, you need to follow your dreams and your passions. And just by happenstance, the guy I was buying houses from had an opportunity. He landed a $50 million fund here in Kansas City. They were buying single family homes at scale. So we were able to buy 265 homes for this fund and did a big refinance across the whole portfolio. So, most people know buy, renovate, rent out, refinance. We just did it at scale. And returned a bunch of capital to the investors, and it still cash flowed. And I was like, man, I got to know, how they structured this. And that's when they said the word syndication. And I just not heard that before. So went on a big educational journey, started to learn, read the books, started going to conferences, started brokering commercial multifamily properties for 1031 exchange buyers, and started to buy some properties myself, and quickly found out that this is a business and it needs to be run as a business. And I knew my strengths. I was highly focused on strength finders, Colby assessment, Ray Dalio's Principles U, all of these different things to try to understand what I was bringing to the table. And then I knew the transaction process, and I knew that I did not like all the paperwork. I didn't like the finance, accounting, business implementation, management of the deal. It just wasn't for me. But there are people out there that do love that stuff, man. That's what fills their cup up. It doesn't fill me up. It drained me. And so I overlaid this model of Ikigai, which is the Japanese meaning for life, basically the intersection of your greatest strength and your greatest passion. And I overlaid that with the commercial real estate world. And then I found partners who kind of filled the gaps that I had, right? And so that was back in 2019. We started to buy a few smaller multifamily properties. And then, in March of 2020, COVID happened. And, I was big on shopping centers, still am. But with COVID, we had no idea what was going to happen. Nobody did. So we dropped all $30 million worth of those shopping centers and repivoted into multifamily and bought 1,000 units from April to October, and been building up the portfolio ever since. We're across 4 states now, 1,300 units. We do own this office building I'm sitting in now. We're buying shopping centers, more office now as well. And we've been really building the operational team. So I've got about 23, 24 employees now, and really servicing that, that operational piece of the business that we need to be able to scale. So really trying to position ourselves like Sam Zell did, I think, back in the 80s, probably, when he was kind of getting started or scaling his business, and being able to take on distressed assets. And so the last 15 months been trying to get the right people in the right seats to get the bus moving in the right direction. And so that's what I've been highly focused on, and continuing to just service our current portfolio and try to figure out how to scale, man. So that's how I kind of got into the business.
Awesome. I love it. What a great story. And like I said, a very unique one. And very interesting that you identified as an athlete and loved athletics, but then realized you were burnt out and was like, I actually don't want to do this. So before we get to kind of the company and stuff, one question I do have is how did you know about real estate in the very beginning? Like, why was that always kind of in your eye?
Well, when I went back to school, I was no longer playing football. So when I was finishing my master's degree, so I needed to get a job to pay for housing and for tuition. So I would drive an hour to work every day, and I turned my car to the classroom on wheels, and I started to listen to, John Lee Dumas and Rich Dad Poor Dad guys, and, Lewis Howes and Zig Ziglar and Jim Rohn and all these different guys. And along that process, I started to hear kind of a constant theme of passive income and different income streams. And I got interested in that. I wasn't necessarily the guy to do it online, though, monetizing a podcast and doing all these classes and things. That didn't suit me. I needed to feel and touch something tangible. And alongside that education process, I had mentors in my life that said, hey, man, real estate's been able to create a lot of wealthy individuals over the years. Maybe you should learn about that. And I was going through my own, after that, I was going through my own live-in flip as well. So I was reading all the books as well. So I think that I got the real estate bug from listening to podcasts and things like that, and then talking and seeing it actually, in the real world with these mentors, and then saying, okay, yeah, they own some houses and stuff like that, but I don't want to do that necessarily. And then I got, educated on the fund and how their structure was working. I said, man, I'd love to do this, but just on the commercial multifamily side. So it started pretty early on, probably 8 years ago, when I started just listening to podcasts and talking to my mentors, and then figured out, okay, there are other ways to do it and build passive income, but I like the tangible piece of it. I like real estate. And so that was important to me. I mean, in my master's program, it was all about, theoretical ideas and all these things. And I still graduated and was trying to figure out, what is business? Like, what is business? Can you guys tell me that? because all we're talking about is theories here, and I don't know if this is real. And so I wanted to find something that was real. Real estate, played into that very well.
Awesome. I love that. Yeah, I was having a conversation yesterday with a real estate coach, and I was talking about how I had the same issue where I was like, I know I want to work for myself, but I don't have any original ideas, or at least, they haven't come to me yet. And then you look at some original ideas, right? Like Facebook, and all of a sudden you realize it's just a tech company.
Right.
There's been thousands of tech companies before it. So how to build that was already there. So I was like, okay, what's an established business that I can get into, low barrier to entry, relatively speaking, and boom, here we are. So I love it. So you guys have grown. You're at, like what you said, 23, 24 employees, big in multifamily. But right now you're switching asset classes, right? I follow you on LinkedIn. So kind of talk about, you were talking offline, you're not just 2 or 3 people anymore. So pivoting and moving asset classes is difficult. So talk about what it's like bringing that many people on board in that process.
Yeah, well, I think that, in my whole, I guess, real estate career, I have not just brokered multifamily. It's been shopping centers, it's been office buildings, mixed use buildings. And my partner, Parker Webb, has a vast experience in the retail and office sector as well. And so, we bring a lot of that experience on the development side and on the brokerage side and redevelopment side. It's just not something we had done up to this point to actually be a principal on and bringing investors in. So we have all of the experience. It was just kind of, what are people asking for out there in the marketplace right now? And what are people comfortable in? And that was multifamily at the time. And obviously we've seen that prove to be a good theory and a good thesis. And so that's attracted a lot more capital, which then makes it more competitive and more difficult to find assets that fit your criteria. And so then, okay, well, just like Sam Zell says, when everybody's going left, you got to look right. And so, he did not just stay in multifamily. He had office. He's still the largest, owner of manufactured housing communities in the country, RV parks. He's done it all. And I think that as a sponsor and as a true owner operator, being in the commercial real estate space and being able to capitalize on different opportunities when other people aren't thinking about them is extremely important. And for your investors, it's good for them in regards to diversification. So, that's the great thing about being a passive investor is you get to tap into other people's experience, knowledge, and relationships and say, okay, well, I don't know how to go buy a shopping center or why I would do that, but these guys do, or these gals do. And maybe we should join up with them and get those outsized returns. So I think being a professional opportunist is extremely important, trying to see trends before maybe the rest of the landscape does, the competitive landscape does, and being able to be a first or second mover into that space. And let's be real. REITs did not get into multifamily that long ago. It was office, it was retail before it was multifamily. There was a lot of folks that said, hey, I'll never own multifamily, for good reason. I have some mentors that said, Logan, why would I ever want somebody living in my real estate? And I was like, there's some truth to that, right? And so when you find the right location with the right businesses and the right tenant mix, you can really be successful as long as, the trends that are happening support those theses. And so, for example, on the retail shopping center side, we're not buying these huge big box, Best Buy shopping centers. These are in neighborhoods. They're 25 to 75,000 square feet. They have 5 to 15 tenants in them, maybe one national tenant, and the rest are either regional or local. But there are things that are e-commerce resistant. They're service-based tenants, so it's your tire centers, it's your rent-a-centers, it's the Ace Hardwares, it's the dollar stores, it's the discount stores, it's the Chinese restaurant, it's the chiropractor, it's the physical therapist, it's the bank, those types of things that still maybe aren't as impacted by, the Amazon effect that some of the other things are. So, 86% of all retail sales are still done in brick and mortar. E-commerce has grown from 13% to 14%. That's great. But at the end of the day, people are now wanting to get back out and shop and go see things. And they do believe it or not, now with shipping costs and logistic costs and all these things, that they can find better prices in stores. And so as people are crunched for, lower prices with high inflation, people are going to go back to discount stores and stores to try to find those deals on clearance and things like that too.
Absolutely. Yeah, I couldn't agree more. And that's an interesting stat for sure about brick and mortar, because certainly I like being able to go and just actually hold it in my hand before I actually, buy it. And of course, Amazon is extremely convenient. And, we have an Amazon center right here in Salt Lake. So man, I can't tell you how many things I can buy, and it's at my door in like 4 hours, which is
it's unreal.
It's insane to me.
Yeah, it's unreal.
But did COVID change anything in terms of your strategy for retail, in terms of like making sure, like a tire center, I think would probably be considered essential. Yeah. So are you always just making sure you have at least a few essential tenants?
Yeah, there are always going to be tenants that you service going to that place, right? It's the nail salon, it's the hair salon, those types of things. Businesses that struggle during COVID, I mean, with global, pandemic lockdowns and shutdowns, were restaurants, right? I mean, so not real high on having a bunch of restaurants in a shopping center. And so that's one big thing. And the other one would be like, jewelry stores and things like that. Like, things that when recessions do happen, where do people cut back on? So just being really clear about that. But I mean, the biggest thing for us is understanding the location of these things. I mean, 25 to 50,000 on the traffic count is extremely important. They need to be convenient for people. And there needs to be a supply issue, meaning there doesn't need to be another shopping center just right down the street so that that tenant can just move for, saving $2 a square foot. So I think that's all important. But there are leasing strategies that you can implement, getting ahead of when these leases come up, being able to talk with the tenants. And that's just a completely different business than the multifamily space, but has systems and processes and KPIs that you can put on if you manage it the right way. COVID gave us the opportunity to look at shopping centers and see how they performed, right? So now we have even a better look at, okay, well, how did the tenants do in the last 2 years? Were they able to pay rent? Who struggled? And I think what happened was, if you were a weak business and you weren't able to make up your rent because of COVID, you probably got wiped out anyways. And so maybe it made these shopping centers even stronger. And I think owners are being a little more cautious about the businesses that they're allowing to come into these shopping centers, and tenant mix is super important. But being able to see how they performed over the last 2.5 years is extremely eye-opening for us to say, okay, well, I don't think another lockdown is going to happen. So, okay, well, if it does, then how did it perform? And what's the tenant mix looking like now, and what are they subject to? So just more data, more insights now, I think actually can create more clarity and create more better informed decisions going forward. We're very cautious and we're very selective on these shopping centers. I mean, it's not just every shopping center in the world that I'll go and purchase, right? It has to meet certain criteria. I want single family homes around it. I want to make sure that cars are driving in and out of this thing. It looks good. And if it doesn't look good, then how can we make it look good? And if we do need to, does that still make sense? I love the ability to, carve out pad sites and sell them to Scooters Coffees or different banks. Like Arvest Bank has got this small concept now that is really tiny, and it's more of a drive-through than anything. But then you can then re-inject that capital back into the project or return it to investors, and it just makes it work really well. So highly selective on the location. This is very important in the retail shopping center world, is location, location, location. I can feel really comfortable going and evaluating a multifamily deal across the country from the data that I have, but going to a shopping center and trying to do the same thing is very difficult to do.
Yeah, absolutely. That's a really great perspective. A lot of good insight on that for sure. Do you guys have like a back of the napkin type thing you'll do with your shopping centers before you even decide if you want to dive into the weeds on it?
Yeah, I mean, well, now that we've got a team, we have an underwriting team and an analyst, so we can get through all kinds of projects really quickly, which is great. I think being able to understand, when leases are turning over, and then the tenant and landlord contributions is extremely important. So the weighted average lease term, or WALT is what it's called, is really, understanding that is important. And then obviously who the tenants are. If you have one big tenant that's making up 50% of the gross leasable space or the gross leasable area, that's a red flag for us. So we'd like to see, no one tenant having more than 25 to 30% of the GLA. I think that's really important to understand too. That way, if maybe one leaves, then you can replace it or you can demise the space. But this is much more hands-on, in my opinion. You really got to go see, look, see how, see that, like, for example, an end cap is going to be a lot different than, a space that you have to drive around the building to find and actually go to, right? And then signage is extremely important too. So there's not as much back of the envelope math. I mean, if it's a 5 or a 6 cap in a retail shopping center, I'm just not going to look at it. It needs to be 7.5 to 9% cap rate before we're going to really look at the opportunity. And then it's evaluating what are the value add strategies. Is it really just, getting rid of legacy leases and re-tenanting the business or the shopping center, or is it a facade, parking lot, lighting, signage upgrade? And then if that's the case, then we have to get contractors through to actually get us those bids, because I can't just look at a shopping center and say, okay, flooring is going to be $2,500, lighting is going to be $1,500. It's just not the same, right? So being able to do that has been important. But we have enough data now, and we've gone through some redevelopment processes on a few of these shopping centers that we do have some back of the envelope math that we can put together. But the due diligence is really important on these deals, and you have to go see them, look, feel, see what the end caps look like, see what how do you get into the shopping center? So it's much more involved, I would say, than maybe just a 50-unit multifamily project.
Yeah, that makes a ton of sense, because with multifamily, ultimately it's one business, right? Like certainly, let's say you have 200 units, right? You have 200 individual units, but ultimately it's one business strategy, business plan, right? Like you said, you can kind of determine what, supplies are going to be, how much it's going to cost per unit, to implement. And whereas this, you have, a tire center is going to be way different than a bank. That's two completely different businesses and two completely different tenants. So a lot more hands-on. One thing that you've been an advocate for, I've seen as well, which is seems like it's a bit taboo to talk about, it still is office space. You mentioned you own the office you're in right now. You're bullish on it, at least from what I can tell. So kind of talk about where that bullish sentiment comes from and what data you guys are seeing.
Absolutely. So you're seeing a lot of distressed office buildings right now. And there's a lot of office that's owned by either private institutions or REITs that, they're not really putting money back into these things to try to get them leased up. Right. And so office you have to be extremely careful for. And what I mean by that is we're bullish on certain suburban office opportunities and not high rises. And so there's been a flight to quality. So maybe think about like this. A business has 3 locations in Kansas City. Maybe COVID said, okay, well, we don't need to have all 3 of those locations. So they're going to have a flight to quality to the best located one and the one with the highest amenities. Amenities are extremely important. Workers want to be able to find food. They want their gym close by. They maybe even want pickleball courts and things like that. So what we've been seeing is a lot of these a lot of these businesses are having a flight to quality in the best located office buildings. And what's happened is there's a lot of these office buildings that just have not had a big injection of capital in them. And so the per square foot, you can't even buy just the land for that same price anymore. And so I think that these are, somewhere between 30,000 to 70,000 kind of square foot office buildings, 5 stories high, really great parking, very close to a lot of different amenities, and the businesses are extremely important too. So what type of businesses are you going to get in these buildings, right? So you think about, architects and engineers and law firms and banks and small businesses like FTW and real estate businesses, collaborative businesses that have to be together to be able to be successful. CPA firms is another one that I've seen a lot of. And so I think that you need to be really careful. We're not super super bullish on doing, office outside of our expertise. So the Midwest and really Kansas and Missouri, just because we know those markets really well. And then I can tap into the top leasing brokers and say, okay, what are you seeing in regards to subleasing activity? How are new leases, what are they coming in at? What are they asking for in regards to the actual contribution from landlord for TIs, for tenant improvements? What are you seeing in regards to leasing activity? How many new leases? How many tours? And so again, it takes a lot of time. You can't just get on CoStar and make an evaluation and run a pro forma. But when you do it the right way and you find those right opportunities, man, you can find some diamonds in the rough. And we're in the Midwest. So office, I'm in the office. I've been in the office for a long time. Most of the people that I talk to, they like going into the office. They're tired of being in their apartment complex, working from there. So they like to have their collaborative workspace. My sister is the same way. But some people will want to work from home. And so you have to really understand, okay, again, who are the businesses? What is their business? Can they do it via Zoom and still be successful? Because there's a lot of businesses that can do that. And if so, that's fine. But how are you going to attract those tenants that I actually just talked through? And what is the plan to do that? So very selective, very careful on the location, flight to quality, has to have great parking, amenities around that. But if you have those things, then you can find a diamond in the rough, and there is less and less people going after these opportunities. So I think that the return to work, or the return to office trend will continue in specific locations, and maybe not downtown in the big central business district, but for sure close to the suburban markets where people live. So those are kind of the thesis that I've got on the office buildings right now.
Awesome. I love that. Such great insight, because like you mentioned, the downtown office and things like tech, right? Like probably not going to be searching for a tech company as a tenant, because everywhere you look, every tech employee is like, no, I'm staying remote. So there you go. Right.
Yep.
You can do it over Zoom. In fact, I think the data is even showing that most tech companies have been doing better via remote work in some sense. So that makes perfect sense. So it's a little bit more urban, which I love, because then, I think about the urban around me office, and it's that small, it's nimble. And man, you said parking like 3 times, and it's like, gosh, I have literally like almost canceled appointments because I couldn't find parking.
Yeah, it's an issue. It's an issue in any big city, mid-sized or big city. And so, workers, if you're going to want them to come back to the office, they don't want to have to park or get in a parking garage maybe and try to pay for parking. And so, parking's huge, and it's a big, amenity for a lot of these businesses that we're seeing in office and that are working out of offices.
Absolutely. So one thing I want to touch on here before we bring it to a close, I want to bring it down to the investor level. We talked off camera, how you're kind of educating investors on the fly. You guys are, I believe, developing a 55 plus community, right?
Right.
Working on, is it all right that I mentioned the mobile home park?
Absolutely. Yeah.
Okay. So you've got that, you've got the office. So kind of talk about, this at the investor level and these different asset classes, and having to educate them and raise that capital.
Yeah. Well, I think that being able to bring experts on in my local market on our podcast is extremely important. So folks can get access to them, so they know, they don't just hear it from me, but they actually hear it from practitioners out there. So that's been one way that we've been doing this. But we have monthly webinars that are, helping to educate investors around macroeconomic, trends that we're seeing. And then, just by happenstance, you have to be able to understand what your investors' different goals are, because the guy that I was with last night or yesterday that was 65 and running a family office, his goals are a lot different than the 30-year-old guy that's accredited investor now and has a bunch of money with no family and no expenses, right? And so the risk profiles are a little bit different, their goals are a little bit different. So we look through real estate, and we have kind of an acronym called the ideal investment. So real estate can provide income, depreciation, equity buildup, appreciation, and you can use leverage to do that. And so at the end of the day, we have cash flow investors, we have appreciation investors, we have a mix of both, and understanding what those goals are and highlighting that, hey, this retail shopping center is, average cash on cash is 8.9%, and it's going to start, 3 months after we close. Or saying, hey, we've got this 1970s multifamily project, and you probably are going to wait for 9 months to get a distribution because we're working on the value add plan. So, those are different investors. And so making sure that we know what the investors' goals are, highlighting that each project has different kind of, benefits and risks to it. And then trying to pair those up is extremely important. We have investors who just say, hey, whatever you do, we're jumping in and we're rocking and rolling with you. We trust you. But, we have now gone through a lot of training with investors. We have, market segmentation on our list that says, okay, this investor has said this on a call and they've gone to this webinar. So we try to do, a lot more targeted outreach to those certain investors that we think are going to be, aligned to the actual project. But then also, the podcast helps, the monthly webinar helps, the deal webinars, like I'm jumping off of here and, presenting to over 100 people on mobile home communities, right? And so my operating partner is coming on and going to talk through the actual day-to-day, and I'm going to talk through the thesis, and we're going to rock and roll on that deal. So just continuing to do that on a regular basis, and I say this, I mean, I think that we try to talk through contrarian views quite a bit. And, as capital is flowing into multifamily and industrial, prices get bid up, returns go down. You got to think about other things. And the way that you can do that is by thinking about the risks applied to each one of those. And so I have investors that say, hey, I'm glad that you're doing shopping centers. I live in Silicon Valley, or I'm glad you're doing office buildings. I live in Silicon Valley. I'm not investing in that thesis. I'm not, but hey, that mobile home community, that's awesome. I can't find anywhere to live or, an apartment here where I live. And so being able to say, like, that this is going to be for me because I get it, is important. So then it's like the breadth of your investor base. And so making sure that you have investors on every single one of those spectrums, highlighting the benefits and the risks of each, and then trying to align those with the investors through all these different educational webinars and podcasts that we're doing is the approach we're taking. And it seems to be working.
Awesome. Wow. You've got Lee working on overtime then, it sounds like.
He is working a lot. I will say that.
Great kid. Lovely. He's very intelligent. Him and I have chatted a few times. Lee is there. He's just investor relations director,
That's right.
head of. Yeah. He's their investor relations guy. Super smart, but yeah, that's awesome. And I love, sounds like you're breaking down the data, like, your investor data even more to really, like you mentioned, have that targeted, like, hey, we know this guy won't like this mobile home park. Are you still doing a full blasted list just to see, or are you actually like, no, we know this person wouldn't like this, so, or it doesn't fit his goal or his sentiment, so you don't even bother?
Yeah, what we'll do is we'll send out a blast to the whole list, and then we'll see who engages with that. And then based off who engages with that, then we hone in the message for those individuals. And we stop, if you didn't engage with the first 2 emails that were about mobile homes, you're probably not coming to the webinar. You're probably tired of seeing that email. So making sure that we don't just continue to blast you with stuff that you're not really interested in saying. So after the first and second email that goes out, we then segment that and then hit those investors with more targeted messages. Absolutely.
Awesome. I love it. Well, I really appreciate all of your insight. I always enjoy talking to you. Your perspective is incredible. So that brings us to our final 5, which is our last 5 questions. First question, best advice you've gotten from a mentor?
Oh man, I would say be quick, but don't hurry. And, that nobody's going to light a fire under your own tail. You've got to do it yourself. And so intrinsic motivation is extremely important, but don't get in a hurry. You got to be quick. You got to move fast, but don't be hurry. You got to be patient. And I think the best thing that I heard was, somebody said this, I think it was Wayne Dyer, but infinite patience produces immediate results. And so, we are in this game. This is a build wealth over time and build wealth slow type of game. It's not a get rich fast one. So just be patient, be quick, but don't hurry. And you got to light that fire under your own tail.
Awesome. I love it. What is it about your career that makes you feel like you're fulfilling your why?
Well, I think that I get to it's challenging. So that's the first part is building a business is a challenge, but what we do on a regular basis is provide affordable, safe housing and places for people to live and work in. And I think that's really great for me. Is like the why for me is I can actually have an impact on the community and the things that I'm doing. I'm not just selling a widget on Amazon or something like that. I get to go meet with nonprofits who are looking for affordable housing in the community. And that really kind of resonates with me, to be able to have that impact, see the success stories that go through that, and then working with these organizations and seeing what I can do through my network or our own business to be successful has been awesome.
Awesome. I love that. Favorite non-real estate or investment related book?
Man, I would say MJ DeMarco's book, Millionaire's Fastlane. It really kind of broke the chains for me in regards to kind of like the mainstream media and all the things that you hear and you think you're supposed to do. It really helped me think outside the box a little bit. And the 1% of the 1% don't think like the 99%, right? And so his book really helped me with that. It was an eye-opening experience and a little polarizing, but for me, it was exactly what I needed.
Awesome. I love it. If you could have any superpower, what would it be?
Oh man, I would say, I want to say go back in time, but that's probably not the right one. I would love to be able to transport myself so I did not have to drive. And I say that in Kansas City. I was like, we don't even have traffic, but if I could just say, hey, I'm going to grab my kids and I'm going to push a button and be at daycare and drop them off, and then push another button and be in my office, dude, I would love that. That'd be my superpower.
Awesome. I love it. Last one. What's the best way for people to get a hold of you and learn more?
Yeah, I mean, I'm on LinkedIn every single day. So Mr. Kansas City, Logan Freeman, I try to post every day, except for maybe not on Saturdays and Sundays. Our website is ftwinvestmentsllc.com. I have a weekly blog that goes out that's gotten a lot of praise. It's pretty polarizing. It's helping people think differently. That gets posted on LinkedIn as well. So you guys can check that out for sure.
Awesome. Yeah, I enjoy your content very much. At very minimum, guys, go follow him on LinkedIn, because again, that sort of contrarian view on things is very important. Even if you don't agree with it, it's super important. Listen, if you're an entrepreneur, it's so important to read people who even disagree with you.
Yep.
So love it. Awesome. Logan, thank you so much for your time. Really, really appreciate it.
Thanks for having me on, Johnny.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way, so please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think, and we will see you on the next one. Thanks so much.